This video continues our conversation on introduction to market efficiency, where now we've laid out the three different types of market efficiency, and we've had our number of questions, and we're going to continue with our challenges in our final section, where we have at least 10 that we're going to talk about and how it challenges market efficiency. And we've made progress in behavioral finance over the last decades here since the 70s and 80s, where it was a new concept. And we've finally have built more and more, I want to say credibility, but more evidence around the questions that we have for market efficiency. And yet the battle continues. So we're going to explain why the debate rages on and why there's no clear winner on who's right and who's wrong. And so this is called the joint hypothesis problem. So once again, I talked to you about the information paradox on the last video where we talk in a circle. This follows the same thing. And I only have two of these here for you. So once we're done with this, we're done with the mind paradoxes and circles here. But in order to test market efficiency, right, we have to maintain two hypotheses when we're testing this. Okay, so all tests of market efficiency have two hypotheses. Have two hypotheses. And number one hypothesis is markets are efficient. Markets are efficient. And number two, that the pricing model is effective. Pricing model is effective. Okay, so we've talked about the capital asset pricing model, and that was the first model that captured systematic risk through the beta measure. And it was so pretty because it could just follow this nice straight line and we can come up with expected returns. And as long as everyone acts perfectly rational, price should always equal value. But then we started finding out that that's not always the case. But when we did that, what we were trying to do, we were trying to reject these tests. And so if these are the two hypotheses, rejection of these hypotheses mean either markets are not efficient and we can just conclude that and take our win and go home. Markets are not efficient. Or it could be the second hypothesis that the pricing model is faulty. And this, but which one is it? We can't ever determine because we can't do both at the same time. Because either we will say, hey, we reject this, markets are not efficient or pricing model is faulty. They'll go back and say, yeah, the pricing model was faulty, but markets are still efficient. Or this is how it continues. We can't try to reject both at the same time. And this is why the battle continues. And this is also called the joint hypothesis problem. Joint hypothesis problem. In other words, we cannot reach a conclusion because we can't prove them both right or wrong. So what ended up happening is we had early evidence in behavioral finance that there were excess returns for small caps versus large cap stocks. So companies that were smaller outperform the market. Now, the important part is here, if you have a small cap stock, they should outperform the market. But even after factoring in beta risk used by the capital asset pricing model, it still had alpha, which is what we refer to in finance as excess returns after risk. So that means we had small cap over large cap after risk. We'll talk about this on another video, but we also found early evidence of value companies outperforming growth companies. And beta could not actually accurately capture it. And so we found alpha in value stocks over growth historically. And so what we said here is, hey, what's going on with these? We're finding alpha pretty consistently across all different markets and all different historical times. And so we went back. These are the behavioralists, right? Asking these questions and challenging these market efficiencies. So we said, hey, are markets not efficient or what? And this, we take it back to, this is now the Chicago School of Business in the University of Chicago. And they say, number two, pricing model is faulty. So that's when we go from CAPM, which has that beta measure, into what we call Fama-French three-factor model. And that was Eugene Fama and Kenneth French out of University of Chicago. And they had the three-factor model, which was beta, small caps. They have a factor for that. And they had a value growth factor as well. And so they put back, markets are efficient, pricing model is effective. And then behavioralists came out and found mounting evidence in a lot of markets on momentum trading, a trading strategy that we'll talk about. So if something has performed well in the recent past, it's going to continue the momentum. So you want to buy high and sell higher, essentially. And so we said, hey, this is happening in basically all equity markets except for Japan historically. So what's going on with that? Number two, pricing model is faulty. Go back, and Carhart came up with the fourth factor. So now we have this Carhart four-factor model. And four-factor, and that adds in this momentum, this monthly momentum factor. And there's our fourth factor, putting pricing model effectiveness in place. And I just looked here, and there's recently Fama-French came out with another five factors. So they dismissed momentum and they changed it into, I think, profitability and capital income. But I usually stop at this four factor. But just to throw that bug in your ear, that there is a five factor model in, and that this battle rages on because we can't prove it. And as soon as there's enough evidence to prove it, we'll just bake it into a better pricing model. And then markets are efficient based off of that. So anyway, the battle continues, but there's enough challenges that we have to talk about it. And what I'd like you to think about as we move into this next section is, do you believe that they will persist? Will these excess returns continue? Was it a flash in the pan? And then furthermore, should you use this in your own portfolio, or should you stick with a more passive index investing plan? That's ultimately where we're going with this. And especially if you're talking with your own decisions or with your clients, you want to understand these beliefs in order to drive some of these strategies, and ultimately how active you want to invest, or if you want to be a passive investor. Beat the market or be the market. That's ultimately where we're going to go at the end of this. But next, we're going to start that conversation on these different challenges. So see you on the next video. Thanks for watching.